from an agenda standpoint, first we're going to talk about what tax planning is, who it's for, and why it's beneficial for everyone to go through a tax planning process. Okay. And then we're going to try to just do a quick dive into understanding how the tax system works and how we can use it to our advantage depending on each of our situations. And then we'll get into kind of some of the meat of the tax planning presentation where we can start looking at ways that we lower taxes both now and in the future. And then, of course, again, at the end, we're going to touch on some action items while also give some time for some Q&A in there. So again, for the Q&A, just go ahead and use the chat feature and put in any questions you have as we go, and we'll again answer those towards the end. Okay, what is tax planning? Okay, tax planning is aimed at lowering your tax burden both now and in the future. Okay, we help our clients do this by carefully reviewing their tax returns on an annual basis and determining really the best approach for their unique situation. You also don't have to work with a financial planner to accomplish this. Every action you take to minimize a tax liability and maximize any deductions will have far superior return on your money over time than doing nothing. Okay, so who is tax planning for? Really, in short, everyone. Okay, so whether you're single, married with children, or a small business owner, or even someone looking to pass down money efficiently, tax planning plays an essential and unique role. Right, so the sooner one can start tax planning, typically the better the situation. But don't be alarmed if you haven't done much to this point, as there's always opportunities to make an impact with tax planning. All right, and then tax planning is a very important piece of the overall financial plan. It is simply that, a piece of the pie. Okay, so a well-rounded financial plan, including tax planning, investment analysis and management, risk management, estate planning, and setting goals, the intentions behind those goals. That's really what's going to help set that financial future. Okay, and whether you're worried about an impending retirement or still have 20 years to accumulate before retirement, having a flexible financial plan that shows the outcome of various financial decisions will make it easier to sleep at night knowing you're on the right path there. Okay, so why would you need tax planning? Well, tax planning touches every part of our financial life. Okay? And when we start a new year, taxes are usually top of mind, and reducing our tax liability is usually at the top of that list. Okay, so with the Tax Cut and Jobs Act sunsetting last year, we have this window of opportunity with now what we call the O3BA, but the One Big Beautiful Bill, and take advantage of some of these lower tax rates that have been made permanent, which means until the next administration comes in, but they've been made permanent going forward for the next few years. And so as our national debt keeps going up, at some point in the future, we do feel that the tax rates are going to be higher. So we want to look at reducing this. Okay, and one little piece that I always like to talk about here is that always remember that your tax return is a financial fingerprint. Okay, it's completely unique to you and complete with valuable clues and information, which is just buried in dozens of pages and hundreds of numbers. So when we talk about tax planning, that tax return is a very good start to look at. Okay, now we're going to do a little bit of a dive into the foundation of the U.S. tax system and just kind of how it works. It is fairly high level. We're not going real deep into this. I don't think anybody wants to learn about the tax code in depth today. So, but the U.S. uses a progressive tax system, meaning that as your income increases, so too does the percentage you pay in taxes. There are 7 federal tax brackets, the 10, 12, 22, 24, 32, 35, and 37. Okay, so in general, someone making $50,000 a year will be in a lower tax bracket than someone making $250,000 a year. But no matter which bracket you're in, you probably won't pay that rate on your entire income. With that progressive tax system, the government cuts your taxable income into chunks and then taxes each chunk at a corresponding rate. So one quick example is a single person with $100,000 in taxable income per year will have some of their income taxed in the 10% bracket, some at the 12, and the remaining amount in the 22 bracket. This leaves an effective tax rate of roughly 17%. So we can start to see there that while we don't get the full amount taxed at that 22%, but we do get some taxed in the 12, in the 10, and then the rest in the 22. And that brings that effective tax rate up to about 17%. Okay. So, but when we talk about that income, whether again it's 50,000, 250,000, let's look at how your income tax is determined. Okay, so first here we have what's called adjusted gross income. This is our total income from earnings and investments minus deductions. Okay, so we're going to kind of walk through what type of deductions count where. But a big important thing that I want to discuss, because a lot of the planning things happen with adjusted gross income, or the second one here, modified adjusted gross income, what we like to call MAGI. And it's just basically, for most people, adjusted gross income is the same as their modified adjusted gross income. There are certain deductions that are added back in. If you've invested in municipal bonds, those are tax-free, but that tax-free portion is added back into your adjusted gross to create that. So there's other things in there that count as well. So, but then ultimately what we're trying to get down to is the taxable income. This is the amount of income you pay taxes on. So your tax brackets, as we look into this, these numbers are all based on your taxable income, not adjusted gross, not modified adjusted gross, taxable. And that is for your federal income tax. Okay. All right. So now when we talk about those deductions, okay, deductions and credits are all over the place. Okay. And there's phase outs, there's all these things. But really what we're looking at is two main types of deductions. And one is called above the line. These above the line deductions are items that we subtract from gross income to arrive at our adjusted gross income. And so these are things such as IRA contributions, student loan interest deductions, and if we put into a health savings account, which we're going to talk about a little bit later, okay? We add up all the total income from all sources and then subtract these deductions to determine your adjusted gross income, okay? Now, below the line deductions have two parts, standard or itemized, okay? Everybody gets the standard deduction. We're going to walk through those numbers in a second. Itemized means we're going to add up all of the little deductions from charitable to medical to mortgage interest, all of those. We're going to add all those up. And if that's more than the standard deduction, then we can use the itemized. Okay? There are certain deductions that you have to itemize to take. Okay, so most people in today's world are using the standard deduction because they just don't have enough itemized deductions to use. Okay, and then these deductions have essentially different functions and they're applied at different stages in that process, but they're both used in calculating that taxable income. So, and any deduction you get does help you reduce that taxable income. Okay, and then there's tax credits. This all comes off the board. These are typically dollar for dollar reductions in the income tax owed. Of getting a deduction on our income, we get a credit for the tax that we were supposed to pay or need to pay or already did pay. Ooh, a little high there. Okay, so now when we look at the deductions a little bit deeper, again, we're kind of going into those below the line deductions here. One of my favorite memes here too is that which complaining about taxes was tax deductible, but ultimately in here, everybody again is entitled to this standard deduction, and no matter what your income level is. Okay, so you can see in the chart the standard deduction for 2026 depends on your filing status. So if you're single, we're getting $16,100 for 2026. We still need to file our 2025 taxes. So I always like to add both of these at this time of year. And so you can see the increase in the standard deduction that we're getting. Okay, something as we review this chart here, we'll look at this. This is something that's new. This is called the senior bonus deduction, standard deduction. Okay. If you're 65 or older, you're going to get up to $6,000. This does have a phase out. Okay. So if you make more than 150,000 in modified adjusted gross if you're single, or 250,000 if married filing joint, this is fully phased out for you at those points. Okay. But we do have the ability to take this if you're 65 or older, all the way through the 2028 tax year. This is something from the One Big Beautiful Bill, again, what we're dubbing O3BA. And essentially, this goes on top of the already additional senior deduction that's not on this chart. If you're married filing joint and you're both 65 or older, you get an additional $3,300. So we can start to see if you're married filing joint, this is you're going to get 12,000 from the extra senior and an extra 3,300 from the already senior age 65 or older senior deduction. So you can start to see where now this standard deduction is well north of $40,000, and that's a lot of money off. So this new senior bonus is really going to help out those 65 plus lower their taxable income. Okay, but again, kind of going back to this, once our adjusted gross income is determined, that's we take the above the line deductions from our gross income, we adjust it down to the adjusted gross income, then we take the standard deduction from there to get down to taxable income. Okay, and again, itemized means that we have more deductions than what the standard offers, and we're going to utilize that to get a little bit more of a deduction. All right, so that's kind of a lot, but that's just really the base of how that system works. And there's a lot of nuances in there, a lot of phase out ranges, a lot of different things that come into play. And so that's why having a good tax plan as part of that financial plan is really important to make sure that we don't miss anything that we could potentially get. All right, so now we want to talk about one of the easiest and most simple ways to get a deduction or set up something for the future. And this is retirement contributions. And we're going to look at the two main ways to do this. Okay. When we look at this, we like to divide these into two different categories. It's pay taxes later or pay taxes now. Okay. And this it's never across the board that what we need to do is the same for everybody. Somebody making a lot of money now may want to take that deduction because they're in those higher income brackets than they feel they're going to be in retirement, versus some of us now would rather pay the tax and let that money grow tax-free and come out tax-free at retirement. Okay, and that's essentially the difference between a traditional 401k and a Roth 401k. Okay, so most of us have a 401k or have had a 401k at some point in our life, and we understand that we put money in, that money is deducted, we don't pay tax on that now. It sits in that 401k, grows tax deferred, and then when we pull money out, every dollar is taxable gain and principal because we've never paid tax. Okay, there are such things as called required minimum distributions, RMDs for short. And if you were born before 1960, those start at 73. If you were born after 1960 or after, they are age 75, that those have to begin. And essentially what that means is that the IRS forces you at a certain rate to pull that money out. So you can't just keep it in there forever and not pay the tax. It does eventually have to come out. For the Roth 401k, it's kind of almost the exact opposite, right? We're going to put money into it, but we don't get a deduction now. So we're going to pay income tax on those dollars going in. And instead of the investment growth is considered tax-free, we would like to say tax deferred because you do have to wait till certain things like age 59 and a half and certain ages and things that you have to get through to make that tax-free. But essentially, if you hit those milestones, then every dollar that comes out is tax-free. So there's no required minimum distributions with Roth, which is great. So these are things to think about here. So do we create a tax deduction now, or do we create tax-free or do we do something in the middle where we do some of both? Okay, good financial plan will utilize and go through that. Okay, well, that's your 401k. That's what we call a workplace retirement plan. Okay, outside of that, we have the individual. These are individual individual retirement accounts, or IRAs. Okay, so same thing is true. The traditional, we get a deduction now potentially. We're going to get into the chart that shows that. In a Roth, we pay our taxes now, but it's going to grow tax-free, no required minimum distributions. Whereas here, this is going to grow tax-deferred, and every dollar out of that traditional IRA is going to be taxable at some point in the future when you pull that money out. Okay, so these are the four main types of plans that we have available to us, that if we're working and the company has a 401k, boom, we can put in. Sometimes we get the match, which is great. And then the other side is we've got the IRAs where we can put into those. Anybody can put in. It's just if we get a deduction from the IRA and if we are at a phase out limit to put in the Roth, which is what we're going to go through right now. Okay, so the one thing that we like to talk about here is the contribution limits. Everything's up this year. So if you're under the age of 50, you can contribute to an IRA or a Roth IRA with $7,500. Now, that $7,500 is not each into an IRA and into a Roth. It's $7,500 between the both. So if you want to get $7,500 into a Roth, you cannot put $7,500 into the IRA. And with the 401ks, if you're under the age of 50, the limit for 2026 is $24,500 that we can get up there. Same thing though, if you put $24,500 into the 401k, you can't put any money into the Roth 401k. Okay. When we hit age 50, we have what we call a catch-up contribution. Okay. And in the case of the IRA and the Roth, it's $1,100 this year. And in the case of the 401ks, it's $8,000. Okay. And I'm going to just step over here. If you're between the ages of 60 and 63, we actually can get an additional catch-up of $3,250, making your total catch-up $11,250 instead of that $8,000. Okay. Now, when we look at IRAs, okay, so these are our individual retirement accounts. Okay. There are different phase outs for being able to deduct the contribution you put into the IRA. Okay. And we can look here and we can see if you're covered, meaning that you have a workplace retirement plan, the 401k, 457, 43B, then once your modified adjusted gross income, okay, so this is one of those first planning things we're looking at with that modified adjusted gross income, which is your adjusted gross income after those above the line deductions with some of those certain deductions added back in. Okay. Again, most people adjusted gross and modified adjusted gross are the same. But if you're single and you make more than 91,000 of essentially gross income, then you cannot get a distribution, or excuse me, a deduction from that IRA contribution. Same married filing joint over 149, you don't get that. In between those two numbers, 129, 149, or 81 and 91, that's the phase out range where you can get partial deduction. Okay. If you're not covered by a workplace retirement plan, the non-covered, you can see those numbers go drastically up. Okay, these are the ranges. As if you make more than the high end of the phase out, you don't get a deduction. Okay. Now, the Roth IRA phase out is more for the contribution itself, meaning that if you make more, if you're married filing joint and you and your spouse have more than 252,000 of modified adjusted gross income, you cannot directly contribute to a Roth IRA. Okay. Are there ways around that? Yes, there are. And that's a part of the planning. So it's something a little bit deeper than what we go into in this webinar, but essentially that is called a backdoor Roth IRA contribution. The essential are we make a non-deductible contribution to the IRA and then immediately convert it into a Roth IRA. No tax implication for converting because it's an after-tax contribution. It is a very involved process. There's some IRS regulations around it. It's called a backdoor because it is a loophole. So, but it's doable. We do it all the time for clients. So, something to look at if you're over those limits and want to get money into the Roth IRA. Okay, so one of the biggest things that we see is when we talk about medical costs, how do we get a deduction on those? Typically, we have to itemize, and the medical costs usually have to be really high, certain percentage, usually 7.5% of our adjusted gross income or higher to get any part of a write-off. Most people don't get that year in and year out if they're covered by insurance. So how do we make sure we get a deduction for paying our medical costs? Okay. Not everybody has access to these, but it is growing where more and more people have them. More companies are offering them, more things there. So if you don't have access to a health savings account, don't fret. Hopefully it's coming in the future. But this is the only thing out there that is what's called triple tax advantage. We get a deduction, whether you itemize or not, get a deduction up front. It grows tax-free. You can invest it too, so it doesn't have to just sit in cash. And then when you use it for qualified medical expenses, it comes out tax-free. So we can use these to save up for future medical expenses, like in retirement. You can pay for Band-Aids, you can pay for some Medicare costs, you can pay for a lot of things there. Okay. But you do have to pair these with an HSA eligible health plan, which we're going to look at here in a sec. Okay. So an HSA is a way to save for the future or get a deduction for the money you know you're already going to spend this year for medical costs. Okay? So contribution limit does matter if you're on a individual health plan or you've got your whole family covered on that health plan. And you guys can see here the contribution limits. So 2026, we did get an increase of $100 and $200 to the self-only and the family. Okay. The catch-up contribution, so sometimes this gets confused because our 401ks and IRAs, our catch-up contributions start at 50, and the HSA it's 55. Okay, so it's $1,000 extra that you can put in to those. Okay, now here's a couple of the rules on the HSA eligible health plans. So they do have a minimum deductible. Most of the time, we don't find this is very hard to hit in today's health insurance marketplace. But as long as your deductibles are at least $1,700 for single and $3,400 for family, then your plan is now HSA eligible from a deductible standpoint. And then we've also got the out-of-pocket expense limit. So these are just the limit on how much your out-of-pocket can actually be. Which basically includes everything except your premiums and your costs for that insurance. So deductibles, co-payments, things of that nature. So just something to think about if you're not putting into an HSA and you have the ability to do so. Some companies even match the HSA. It's one of the best things to do. Usually one of the first boxes we're checking to see if that's even available. So if you can't get more money into a 401k, you can't get more money into an IRA or a Roth, HSA is usually a really good stop. Okay. One of the other things here is some charitable strategies. Okay, so we're going to walk through really one of these, but just wanted to look at a couple of ideas that we have. Okay, so typically to get a charitable deduction, we have to itemize. Okay, so meaning that we're going to have enough charitable deductions to create that the itemized deduction that's higher than the standard deduction. Okay, and so when we use these charitable deductions, anything that we send to a 50C3 public charity or 501c3, sorry, public charity, we can get those itemized deductions. Okay. So, but if we're, taking old clothes to Goodwill or something like that, it's going to be very hard to beat that 31,000 and change standard deduction doing that. Okay, so we have to look at that extremely carefully to see, does it make sense to do this? If we're not getting a deduction, is there a way to bunch those together? Is there a way to take advantage of maybe doing a lot in one year and less in others? Okay, and so that's what we're going to talk about. One thing to note here, there are such things as called planned gifts that pay income back to us. So these are all things, these are very advanced planning strategies, charitable remainder trusts, charitable lead trusts. These are things that typically we have a specific both income and estate plan, but we can use some tax things in there to really help generate a better income and create some good estate planning strategies. So just want to put those in. But what I really want to talk about right now is what's called a donor advised fund. Okay, so we use these quite often for our older clients usually, but anybody can use them. But basically, it's a way that we put money into this donor advised fund. We control it. We get to invest it. We get an immediate deduction now, but then we can invest that money and give it to charity as we see fit, when we see fit. Okay, so one of the things we love doing right now from a planning strategy is donating what we call appreciated assets. Okay, so we've seen a lot of growth in the market over the past really 15 years, but really since COVID, we've seen a nice big move up in the markets, and we see a lot of people that have high capital gains in their investment portfolios. So if we're charitably inclined and we're looking for a tax deduction, we can just move some of those appreciated securities over to the donor advised fund. We get immediate tax deduction now. Anything that we can't take today, we get a 5-year carry forward on that. But the best thing is we don't pay a dime in tax on that capital gain. We get to move it over. We can diversify it. You can keep it the way it was, but we get that nice deduction now. And it's a way that we can kind of bunch it in this year, then take the standard next year, maybe the next few years, while we give our charitable goals we give from that donor advised fund. So there's some other things in here with charities that everybody gets a certain amount of a charitable deduction, regardless if you itemize or get a standard. That's all new from the one big beautiful bill. So there's a lot of little things in here that we're not going in depth in today from a time perspective, but there's a lot in there that are doing that. The donor advised fund, the reason that I like to show this is it's something that some people have heard of and a lot of people haven't. So it's a really good way to hit our charitable intentions over many years, right, and get a really big deduction this year that we can pair with other planning strategies. Okay, and then again, kind of going forward from that, we've seen a lot of gain in the markets over the last 5 to 15 years, depending on how we want to look at it. We also want to talk about how we can help lower that tax bill with some things that maybe haven't done quite so well. Okay, so essentially what we're doing here, there's tax loss harvesting and there's tax gain harvesting, and there's reasons why we do both. Okay, so essentially we sell an investment at a loss and we can capture a tax deduction now, and the tax deduction works in 2 ways. One, it offsets any gain that we take. Again, when we buy a stock and it grows, we don't pay tax on that until we sell it. Okay, so if we sell it, we have a capital gain. If we sell it at a loss, we have a capital loss, and those offset each other. Okay, and not just from stocks, there's other assets too. But to keep it simple, if we sell $10,000 of Ford stock that we bought for $5,000, we're going to have a $5,000 gain. But if we turn around and sell XYZ stock for a $5,000 loss, we offset those. There's no impact. Okay. Well, the greatest thing about taking the losses, we can reinvest them right away if we feel like that position hasn't done well or we don't think it's going to do well. We can offset some tax structure there. But the best part about it is we can take up to a $3,000 deduction on our investment losses per year, and they'll carry forward in years that we can't use those, whether to set up offset capital gains in the future or take $3,000 per year of a deduction off our total income. So there's things with this here that this can do. Now, one thing that's never talked about a lot in tax loss harvesting when we plan for this is what's called the wash sell rules. These are very important. It's a very in-depth rule that the IRS has out there. I'm going to try to make it pretty simplistic here, but the basic concept is if we sell an investment within the 61 days of that, we can't, the 61 days or the 30 days before and the 30 days after, including the day of, so 61 days, we cannot buy a substantially the same position. So again, if we sold forward in here at a loss, we couldn't have bought forward 30 days before that, and we can't buy it for 30 days after, or that loss will be negated. Okay, but we can go buy GM. Okay, we can buy Tesla. We can buy those because it's not the same stock. We can use passive ETF to cover that for those 30 days. So there's definitely things we can do in there to make sure that that loss is actually taken on. Okay, so real important there. All right, so that's essentially the wash sell. It's very complicated, very convoluted, but it's something that all of our systems, all of our stuff takes into account. Okay, so then just going through those capital gains and losses, this is kind of how it goes. So if our gains exceed our total losses in selling, then the losses are used to offset those gains, and then after that, it goes to taxable income. Okay. If the losses are in excess of gains, then those remaining losses are deducted from ordinary income. Okay, and so that's that $3,000 loss that we talked about. Okay, so if total losses exceed gains, we first take them from the gains, net those out, and then anything remaining goes to our tax return as a deduction. Up to $3,000 for that year, and then we carry forward anything else that in the future will be used to offset gains or take as a deduction against ordinary income. So very good things with that from a tax loss harvesting. So if you've got an investment portfolio outside of your retirement accounts that's got big gains or has some losses over the years, this is something to really look at and to see if you're charitably inclined. We can even offset some of that really high gain position with some charitable things there. So just something to look at. Really wanted to go through that as we get into 2026. Right? Okay. All right. So next, we're going to walk through some action items, Q&A. I wanted to leave a lot of time in here for Q&A in case somebody had some major questions. But first off, from an action plan, it's the beginning of the year. So we always want to check that our 401k contributions are exactly where we want them to be. Okay, so we did get an increase in the amount we can contribute. So make sure with your HR department online on your 401k login that you're contributing the max that you can or want to do that. We have until April 15th to contribute to an IRA or a Roth, again, within those phase outs for 2025. So if we didn't put anything in 2025 for 25, we are allowed to continue to put into those IRAs and Roths through tax day, April 15th. Okay. Check on the HSA. If you don't know if your company provides that for you or not, check into it, see if they have it. It is, again, one of the best things we can contribute to. We don't see medical spending going away, and so it's something that we want to take advantage of if we can. And then sometimes at the beginning of the year is the best time to harvest some gains. And then if we have any losses, we can offset those. Again, be mindful of that wash sell rule on those losses. But then anything from a charitable intention, if there's something out there that you want to look at a little bit deeper, please don't hesitate to reach out to us here. You can see my contact info is right there. Happy to walk through anything with you guys on that. Just shoot me an email. I'll be emailing you guys the recording of this and the slides and everything either Friday or Monday when it's compliance approved, and then we'll go from there. So let's go into Q&A. Okay. Okay, first question. Can you combine the standard deductions? Let's say you file as married couple jointly and also as head of household. That's a wonderful question. I don't know if you can file married filing joint and head of house. But either way, it's typically only one standard deduction per tax return. So not being a CPA, I can't go too deep into that. But what I can tell you is typically the higher the two would probably win out there. But yeah, you're not going to be able to combine standard deductions from both into one. But good question there. Is there a benefit to doing a Roth swap in the 5 years leading up to retirement? Another great question. I'm going to make an assumption here, but I assume that by Roth swap, you mean a Roth conversion, move our assets out of the traditional and into the Roth. If that's the case, there is a benefit to doing a Roth, and there is a nice analysis that goes with it. Assumptions need to be made about tax rates now, tax rates in the future. But the most important thing is getting it put in place. So we do believe in Roth conversions. We do them quite a bit for our clients, and it's something that we look at the financial plan, the tax plan, and to help us determine is that the best course of action? Either now, do we wait until retirement when our income is lower? There are certain parameters there, but yeah, we 100% agree on doing that. And what we do tell people too, just from a side note here, is if we're looking to get out of traditional IRAs, 401ks, and into Roth, the first place we always say to look at is your contribution to your 401k at work. Switch that over to the after-tax version. Start creating the Roth account there, and that's going to help alleviate the future of that traditional continuing to grow by you putting more money into it. So, but yeah, wonderful question. Okay, so next question: Where does monetary gift factor into the calculation of reducing your taxable income? Wonderful question. Again, sorry, make a few assumptions here, but if we're talking about a monetary gift down to like our children or something like that, there's generally no tax deduction for that. There can be gift tax. There's 100 ways around that. But if we're going to give a monetary gift to our children of $15,000, that's within the annual gift tax limits, and so there's no gift tax on it, but there's typically no deduction there. If you're given a monetary gift to say like your alma mater, then that's a charitable gift, and that one does come with a tax deduction, again, as long as they hit the certain parameters of being a public charitable institution, which most universities fall into. Okay. So hopefully that answers that question. If not, please feel free to email and we can talk about that separately. Okay, next one. Can you max out both a 401k and an IRA? The answer to that is yes. You just have to watch those phase outs for the deductibility of the IRA if you're covered by a 401k at work. Okay, so maxing out an after-tax IRA is definitely doable, and it's a planning strategy. There's just certain things you have to keep up, because you have to keep up with the after-tax balance and the pre-tax balance. And the IRS has a tax form that you do that on, called the 8606. So, but yes, you definitely can. All right. Okay. Okay. Is all capital gain taxed, or is there a lower limit before it gets taxed? Yeah, wonderful, wonderful question. So, capital gains bracket is slightly different than the ordinary income brackets. Um, let me get back to that real quick. That should help. Okay, so essentially it's off by a few $100s, but if you're within the 12% tax bracket on the ordinary tax bracket, so in that case it would be, if you're single, it's 50,400. If you're married, filing joint, it's 108 or 100,800. So if you're right in there, and again, it's off a few $100, the capital gains tax bracket is different than the ordinary federal income tax brackets. Okay, so but if you're within that of all of your taxable income, all your capital gains are tax free, capital gains and qualified dividends. Okay, so they can absolutely be. And if anybody wants to go to our YouTube channel, the Noble Group, we've got a great YouTube channel of educational videos. There's actually a video out there on living retirement this way that we've filmed and put out there. So I think the title is how to pay tax on 120,000 of income, or zero tax on 120,000 of income. It basically walks through how that works. But yeah, so if you're in those capital gains brackets that basically mirror the 12% bracket or below on the ordinary, then your capital gains are tax free. So great question. Beginning in 2026, is there a portion of charitable contributions that is not deductible? The answer to that is yes. The One Big Beautiful Bill did create a floor there. It's off the top of my head, I don't remember exactly what it is, but it's around $1,000. It's in between $1,000 and $2,000. Anything after that is deductible. So it's something to 100% look into on those charitable contributions. Again, the standard deduction got raised by essentially the same amount as that. So for most people, again, it's not going to affect them because they're not itemizing, which is how that would happen. Okay. Okay. Can you explain the difference between itemized versus standard and which one is better? Well, to answer that question, the easy way is the standard deduction is what everybody gets. Okay, so it's set, it's a number, and it's there, and we'll get. I'll pull that back up. So the standard deduction here, if you're single filer, it's 16,100. If you're married filing joint, it's 32,200. So essentially, each person is getting $16,100. So if you're jointly on a tax return, you get the double that 32,200. Okay, so. And then again, age 65 or older, there's some extra bonus deductions in there as well. But that's the standard. The only way the itemized is better is if it's higher than this number. Okay, so if you have a lot of deductions for, again, medical, mortgage interest, and there's rules behind this, all of that plays into that itemized deduction. But if your itemized deduction is higher, it's almost 100% of the time you're going to take the itemized over the standard. So unless your itemized deductions are higher than your standard deduction, there's usually not a benefit to do that. So the standard deduction would be better in that case. But from an itemized standpoint, if the total itemized deductions are higher than the standard, that's generally better. So, but great question. Okay. Is the 7,500 contribution limit for IRAs for all IRAs? If you have multiple IRAs, can you put in 7,500 to each one? The answer to that, no, unfortunately we can't. 7,500 is the total limit that we can put into all IRAs combined. So IRAs are aggregated. So whether you have 5 different IRAs or one, the IRS looks at that as basically one big IRA. So we get 7,500 that we can put in, 8,600 in 2026 if you're over the age of 50. And great question there. Okay. Another great question here. For catch-up contributions for those over 50, do the contributions have to be separate, or can it be included in the total deferral? For example, can you do a total of 9% deferral, or does it have to be done separately, 8% and 1%? Wonderful question. That's a great HR question. 401k plans, even with the same record keeper, the Fidelities, the Voyas, the Empowers out there, even though they're there, every plan is a little bit different, even with the same record keeper. So I don't want to answer that as a yes, you can, because I know there are plans that can, and no, you can't, because it is going to be plan specific there typically. So if you're in a certain plan, just email me your company info, and I can get that answer for you from our 401k planning team over there. Okay, great question here. I heard there's a special tax rebate for new car owners, having the cars being financed and paying tax incorporated in the installments. Can we have it adjusted in the tax return? That's probably a little bit too deep to answer on this webinar. Yes, the one big beautiful bill did put some things out there about American-made cars and getting essentially a write-off on the interest that you're paying. That is a wonderful question for your tax advisor, CPA, whomever you got there. But yeah, great question on how that's going to work. If you get any rebate from that from 2025. Can you roll over traditional IRA into Roth through your brokerage? Is there any rules to it? Yeah, so essentially, yeah, there's some rules, but the thing with moving your traditional IRAs into a Roth IRA, it does create income tax. So if you had $100,000 in your IRA and you move that into your Roth, you're going to add $100,000 of taxable income to your tax return in the year that you do it. So you want to check that to make sure that's not going to throw you up into these very high tax brackets, pay a lot of tax on that. But there's no income limit on a conversion. So if you make $10 million a year, you can still do it. If you make $50,000 a year, you can still do it on a conversion. No rules there. So hopefully that answers your question there. If you have a loss carry forward, is there a time limit to carry forward the loss? Usually no. Okay. Usually there's not a time limit on carrying forward that loss. I've seen some big loss numbers coming from like real estate transactions that didn't go well, things like that have just been carried forward through the years. So yeah, you should be able to carry that forward forever. When we talked about the donor advised fund, those deductions that we take, that only has a 5-year carry forward. So if we put too much in and we can't take all the deduction in this year based on the rules, then we can carry that forward for 5 years. So in planning, we'll really want to make sure we don't do too much there. Okay. Is there any tax deductions for college tuition? Not really. A lot of what we do from a college planning standpoint is what you do at the beginning. So if you've heard of a 529 plan before, there's not a deduction to put in there, but it does grow tax deferred as long as we use it for qualified education expenses, which is now basically everything, including before college. So with like private school tuition and things like that. So you don't get a deduction to put in, but you do get some tax benefits for the growth of it. And then even that, if a 529, if you don't use it all for college education, you can switch it around. The beneficiaries of that, most of the time are kids, can be switched down to grandkids. And also we can pull out money to put into our children's Roth IRAs once they get out and working. 35,000 total can come out to do that at whatever the rate is per year. So 7,500 per year. But they do have to have earned income to put in. So there are some benefits to that, but typically there's not a lot of deductions we get for college tuition. Okay, can you deduct non-mortgage payments? Say you were living in an RV or a tiny house and you were making financing payments, would those be deductible? That is a great question. I'm not 100% on that. That is a wonderful question for a tax advisor. I would say, because it's typically mortgage interest that's able to write off. So depending on what type of financing, I think might sway that, but I don't know the answer to that. But it's a good question. Okay, looks like final question here. Can you contribute to the Roth 401k as a lump sum payment to meet the limit for that year? Again, I think this is plan specific on that. I know you can just have 100% of your paycheck deferred towards the end of the year. Seen a lot of people do it. Seen people do it at the beginning of the year. So again, it's going to probably be plan specific to what your 401k plan allows. But yeah, it doesn't matter if you put it all in throughout the year. Put it all in at the beginning, middle, in, as long as you stay within the confines of the max amount you can put in. So, yeah. All right. Well, thank you for all those that submitted your questions. Thanks for staying with me on here. Again, I'll pull the slide up here towards the end. Please feel free to reach out, shoot me an email, give me a phone call, anything that works. But we set some time to about your specific situation, questions that you have. But I hope that everyone has a wonderful rest of your week. And thanks again for joining us.